As the economy continues to get worse, consumers are now starting to feel major financial pain, with confidence around employment and the labour market taking a sharp drop, and expectations around inflation over the next 12 months also rising. 62% of Americans now expect a higher unemployment rate over the next 12 months after doubling in under a year. A reading this high hasn't been seen since the 2008 financial crisis and has never been seen before outside of recession periods, a big warning sign that we could already be in a recession or very close to one. Now, consumers are very entitled to grow more fearful when job listings continue to dry up and are missing expectations every month while also getting revised down, and more companies are making layoffs. And on top of this, AI is increasingly becoming a threat to people's jobs, particularly impacting younger people in more junior roles. This can be seen with the unemployment rate for 20 to 24-year-olds surging to 8.1%, another similar pattern to what we saw in the run-up to the 2008 financial crisis, as companies are more prone to lay off their youngest and most replaceable workers during times of difficulty. It therefore makes sense why consumers are noticeably pulling back on discretionary spending across the board, clearly making calculated cuts to spending based on what they can live without to preserve cash for essentials. The problem here is that consumer spending drives about 70% of the entire economy, so if this trend continues, where consumers are pulling back on spending and growing more fearful over the future of the economy, then many businesses are going to start to feel the pain even more too. And it's clear that many consumers are on the brink right now financially when it comes to everyday costs and bills, with credit card debt surging and the number of serious delinquencies spiking as well, reaching the highest level for 14 years. And all of this is now starting to paint a very clear trend. With the Federal Reserve now giving the green light signal that rate cuts are coming in September, this could be the trigger that starts a second major wave of inflation, seeing the price of food, gas and rent skyrocketing even higher and piling even more pressure on consumers trying to keep their head above water. Inflation has already been showing concerning signs of rising again recently, with the latest reading rising above expectations to 2.7%, up from 2.3% in April, while core inflation has also just risen to 2.9%, which is the highest level since February. And this is despite Trump's tariffs not fully kicking into effect just yet, with tariff pauses being placed on trade with a number of countries, as well as retailers still running down large inventories that they had stocked up on before April when tariffs were first announced. Now, these rate cuts could be the fuel on the fire that sends inflation rapidly surging higher, just like what happened during the 1970s, and the current economic situation that we are in is starting to look eerily similar to that period of time. Now, the early 1970s saw CPI surge in an initial wave where it peaked at around 12% in 1974 before the Federal Reserve hiked interest rates from 5.5% to 13% by mid-1974, very similar to what we have recently seen between 2020 and 2023, with rampant inflation followed by rapid rate hikes too. Now, back then, inflation then declined as a result of these rate hikes. However, the economy also entered a recession, with unemployment rising to 9%, and the Federal Reserve eased rates post-1975 as they thought inflation was already under control and wanted to prioritise the labour market and to stimulate the economy. Now, this is the part of the cycle that we are in right now, as we have now seen inflation decline relative to the highs that were seen just a few years ago. However, now the labour market is taking a turn for the worse, with unemployment now threatening a sharp surge upwards, and the Federal Reserve now seemingly is prioritising trying to save the economy over fully controlling inflation by cutting rates in September. Now, when the Federal Reserve chose to do exactly this back in the late 1970s, it did result in an even larger secondary wave of inflation that peaked at over 14% in 1980. Now this turned into a stagflationary period which saw high inflation, slow economic growth and rising unemployment that this time peaked at 10.8%, a scenario that we are now at risk of facing once the Federal Reserve starts cutting rates. The big concern here is that the recent major wave of inflation that we saw between 2020 and 2022 disproportionately impacted poorer and lower income households more than anyone else. Now this is because although the broad CPI reading for inflation did peak at about 9%, the price of essentials that poorer people tend to spend a higher proportion of their overall income on did increase at an even faster pace. Now price increases in supermarkets and grocery store items peaked at a whopping 18.8% year-on-year growth, more than double the peak of overall CPI, and food prices today are 35% higher compared to the summer of 2021, just a few years ago. Meanwhile, asking rents peaked at a 17.7% year-on-year growth, close to double the overall broad CPI, and between December of 2020 and the peak in August of 2022, the average renter would have a 26.3% higher rent cost. Now, food and rent are of course two major monthly expenses for those on lower incomes, whereas those on higher incomes also spend a lot of money on discretionary items and services, many of which did not see prices increase at the same level as the essentials. Now, many consumers are already struggling financially, failing to pay bills on time and taking on more and more credit card debt just to afford the essentials. Therefore, if we do see this same growth trend occur during a potential second major inflation wave, then it could cause absolute carnage across the entire economy, especially with the unemployment rate potentially rising too, with the labour market in such a weak position. But while millions across the US would be struggling even more during a strong wave of inflation and a stagflation environment, those on the opposite end of the scale are set to benefit massively and make a lot of money. Stagflation recessions are so brutal because while most people are suffering from higher prices, higher cost of living, and higher unemployment, the rich are getting richer from asset price inflation. The Federal Reserve would be cutting rates at a time when asset prices are at an all-time high and still soaring, something that is unprecedented throughout history. The S&P 500 is breaking new all-time highs every week, up over 27% in a matter of months, and trading at extremely high valuations that are only beaten by the dot-com bubble period just before the major market crash took place. Home prices are also very close to all-time highs and are becoming more and more difficult for regular households to afford because of how expensive they have become, now at a 5.8 price-to-income ratio, which is higher than ever before. And the price of gold is pretty much going vertical as more and more institutional investors and central banks are losing faith in the US dollar and flocking into safe haven assets that are a hedge against inflation and dollar devaluation. Foreign central banks are in fact dumping US treasuries and aggressively buying more gold for their international reserves, and now for the first time in 30-odd years, we have seen their holdings of gold overtake their holdings of US treasuries as an overall percentage of foreign reserves. Large institutional investors and central banks are well aware of what is about to happen with rate cuts, dollar devaluation, and the rapid expansion of the M2 money supply. Back in that 2020 time period that we discussed before, which was the last time that we saw interest rates slashed, rapid money printing, and a big wave of inflation take place, we did see asset prices surge very quickly in a very short space of time. This time around, with the Federal Reserve cutting rates to try and save the job market, seemingly giving in to inflation, there's no reason to believe that we won't see the exact same thing happen, leading to a big pump in asset prices. But the markets are very different to the economy, and surging asset prices only benefits the ones who own all of the assets, making them even wealthier. But for those poorer working class and even middle class people, then it brings nothing but pain, as these people typically own very few assets in the grand scheme of things, if any, meaning that assets become even harder to obtain, all while these people are seeing more and more of their paychecks disappear on rising food and rent and other cost of living items. Now, this is why the next recession, that is potentially just around the corner, is so scary and could be devastating, because the gap between the wealthiest and the poorest people in society will just get bigger and bigger. The other extremely concerning thing on the horizon is that the jobs market may be too far gone to save already, and due to how lagged the jobs market data is that the Federal Reserve uses to make rate cut decisions, things could already be a whole lot worse than what we even know about, meaning that we could be heading for an economic crisis like no other. Now, I covered this topic in more detail in my previous video, which you can check out by clicking on screen right now. Aside from that, please leave a like and subscribe if you enjoyed the video. That does help out the channel a lot, and thanks a lot for watching.